Well, A Bala has got no reasons to complain ever. So what? He's getting white hair on his mustache. He doesn't complain. He calls them not age, age, wisdom, right? How many years you've been tracking markets now?
It's almost about 34 years, 35 years.
So what was the Sensex when you started?
Somewhere close to about 1,800 or 2,000.
Sensex was 1,000.
Sensex was 1,000. And we have seen...
There was no Nifty.
There's no Nifty. I think Nifty came 90s, 96, I think. I think after the NSE got opened up.
You've
I think it was
really
only Sensex. We have seen only BSC and I've seen a grey market. I've seen
So when you look back
systems.
and you say that, okay, if the Sensex has gone up from 1,000 when you've tracked it to 80,000, what is that one thing you wanted to do differently when you look back and analyze your career or your investment style? I mean, what is it one thing you said, oh, I wish I would have done this differently. I would have created more wealth for my unit holders or created more wealth for myself and my family.
So I think clearly it's about putting of course, the deep understanding of how the compounding work. See, most of us, when you think about investing, we always underestimate the compounding theory. And so I just give you a simple example that when I started my career, so I used to also believe in creating a long-term investing through the life insurance policy. So that's why we all started.
Yeah.
Then we must have 30-year policy for your daughter and son for education. So without understanding the impact, compounding impact on that relatively lower as against the market investing. So this was the lack of understanding of how it can work. So if you look back in my own in the investment style, maybe at any point of time you take a conservative call. Therefore, you remain underinvested in assets which has got a long-term compounding from a wealth creation point of view. Wealth is not the only one that one should target. I think it's all about building the future security, so which everyone has to do from a point of view of having the right amount of wealth and for various purposes, which will include giving back, which will include making the assets available for the families and so on so forth, spending, and as well as for giving. So for which the market provided an opportunity. Therefore, staying convinced on power of compounding is something I would say one of the area where we keep debating, keep discussing. That's why you look at a 1,000 index and 80,000 index. It is nothing but as the economy grows, of course, the market has to reflect that in terms of market cap.
You know, I always tell my friends and folks who ask me that, okay, what is the biggest mistake I have personally done? I said, I started preaching power of compounding in my 20s, but I started implementing in my 30s. I wish I would have started in my 20s. And that 10 year is what I feel in my 40s now. You know, if I would have that 10-year advantage, my 50s and my 60s would have been very different. So Shristi, don't do that mistake. That's what B and Bala can tell you.
As is always said, it's better late than never.
Yeah.
And that's the beauty. So even today, we're still talking about $10 trillion economy and Viksit Bharat 2047, which essentially means $30 trillion economy, which means maybe the next 10 years will be faster. As I always believed in telecom industries, China probably would have taken 35 years to implement telecom revolution, whereas India took maybe about 10 years to bring in telecom revolutions. So the world is moving faster, compounding is becoming faster, the more and more companies are coming. Therefore, as I believe that it's never late than never.
Like they say, jab jago jab sabera, better late than never.
Correct.
How would you describe the current leg of the market? In Jan, everybody wanted to sell all asset classes and move back into dollar, right? Just sell everything and go back to dollar. Now it's the reverse. Suddenly everybody wants to sell all dollar assets and move to other assets. Bitcoin is going higher, emerging market flows are coming back. 6 months, I love you dollar to long live dollar to we don't want to own dollar assets. Why the world is changing so rapidly within not even 6 months, actually 4 months?
I think that the way I see is the number of people who are participating in the market have been rising. And each of the segment of the market players have got affinity towards asset classes differently. The traditional investors, they do look at earnings, and therefore they continue to stay invested in equity, building businesses, and seeing the earnings coming out of the building businesses, generating revenue, generating employment, and generating profit after paying taxes and so on and so forth. That's actually the way any business model is built. But other asset classes, as we always used to say, gold has got only storage value.
Yeah.
But at the same time, it is a hedge against dollar, hedge against inflation. And there are a set of people who also love these kind of asset classes. But ultimately, though they may not have the industrial productions value, but there is a demand supply situation comes in. So every asset class is demand supply. Even cattle, for example, there is a demand supply situation drives those prices. So therefore, these asset classes will remain. But ultimately, in the long run, what sustains is actually the asset classes, which is driven by the earnings, and basis you can apply certain kind of assumptions in terms of the terminal value of this company and so on and so forth. But wherever those clarity is not there, those asset classes will always remain as speculative asset classes. But the question is how much of these speculative asset classes one wants to own in the portfolio, and then how you want to shift your asset class from one to other is something will always remain a big question mark. Not in today's world, even going forward, this will remain. This will be one of the challenging area for even for the people who have been investing in the market. How to avoid this in asset classes, or how much to own or not to own, these decisions will always remain critical. But given the fact the whole the set of people who are in the investing in the market have got different kind of mindset to deal with these kind of asset classes. Therefore, this will have remain. We have to watch. We have to watchful. We have to watch it. At the same time, remain focused on the asset allocations.
But Bala, what as per you is the ideal asset class allocation? Because what we are seeing is that Indian markets, of course, are finding a bit of a resilience amidst the global turmoil. Other than that, the gold was actually losing its shine, but once again making a comeback. So as per you, how should investors place their bet?
So I think there are traditional model. My own belief is a simple traditional model, easy to understand. It's more sustainable, which is nothing but 100 minus your age should be in asset in equity. If you are the age of 20, assume you will live for 100 years, 80% of your assets should be in equity. As you start progressing in age, your equity asset classes should come down and fixed income asset class should go up. But at the same time, fixed income also should be looked at it from the point of view of inflation against how much you earn. If the inflation is about 5%, if your interest rate is 5%, then it's not worth money keeping money in fixed income. It's worth actually putting money in equity, because equity inflation, high inflation means somebody is making money. So that's the way asset allocation should be looked at it. And gold as an asset classes, given the fact is now become a good asset class, silver has become an asset class. So as long as there is a value of sellable value, you can go to the market, you can sell anytime, there is a price that which is fixed on a daily basis. So therefore it becomes also one of the asset classes can be owned. So therefore from a broader investment point of view, 50 to 60% asset class will always be in equity, and 35 to 40% asset class will be in fixed income. You need earning assets at all point of time. Then actually the rest 20% comes in the gold and other asset classes. But unfortunately, the mutual fund side, I think as mutual funds also progress over a period of time, we also moved away from just simple product-based selling to a solution-based sellings. So today, if you look at the whole hybrid asset classes, such as balance advantage fund or multi-asset allocation fund or multi-cap fund, all of them actually generally drives the nature of asset allocations. It invests in equity depending upon where the market is, higher equity depending upon the bullishness that you have in market, and lower equity depending upon how bearish you are in the market. These dynamic asset allocations, which happens in balance advantage fund, dynamic asset allocation happens in multi-cap fund, moving between large cap to mid cap to small cap, and also having gold in multi-asset allocation fund. So such kind of product actually gives a natural solution to the investors. You don't need to break your head, and for you to do your planning of how much should go in equity, how much should go debt, that responsibility now can be given to the money managers by choosing these kind of funds. That's the beauty which I think mutual fund also has created over a period of time to remove the headache of investors in focusing asset allocations on their own rather than choose a product which also serves equal amount of similar purpose.
Certainly, but Bala, the last time we connected with you, you were of the view that the uncertainty in the markets is towards the fag end. What is your current view now? And also give us some sense that from where do you believe the big trigger for the market will trickle in? Because we are getting to hear a lot of news on the tariff, the deals that are through, and even now the bond markets are giving us some signals. Are you concerned about that?
So I think these, I think the way, I think when the tariff was being announced, From US point of view, it is supposed to be one of the best decisions that one could have expected. In the sense, it's supposed to bring in $1 trillion by way of tariff collection, supposed to bring in $1 trillion by way of reduction in the freebies that US government has been giving to the local institutions and research subsidies and so on and so forth. So now with this, this now is getting diluted, and now again, once again, the shift is getting focused towards rest of US from an investing point of view, and within US, fiscal now became a concern. That's why the bond market actually reflects the fiscal correction which was supposed to happen did not happen, would not happen as quickly as possible, plus rating downgrade that happened recently on the base of tariff uncertainty, inflation rising, slowdown in the economy, and so on and so forth. So this uncertainty now getting back shifted to US market. At the end of the day, one should also remember, despite interest rate being high in the US market, companies are doing very well. So companies' earnings are getting now better. Therefore, there is a disconnect between the bond market and the equity market. I'm very surprised whenever the yields are high. Ideally speaking, the bond market, equity market should actually correct. But this time it's not happening because the 7 or 8 stocks which is actually driving the US market, their earnings have been pretty good. They are actually getting growth not just from US alone, they are getting growth from the international market. I assume companies like Microsoft would get large pool of the revenue coming from rest of US. The world is becoming a consumer of US products. Therefore, there is a bit of disconnect. Therefore, you can't come to a conclusion that interest rates have gone up, therefore it's negative for equity. That's why I think this uncertainty will remain. But having said that, economies like India, in the whole tariff thing, I think we seem to have managing it quite well, and the impact on India is going to be relatively less. And I think Indian economy is doing well. I think first time I'm seeing the last number of years, fiscal, we are in a sweet spot. Indian fiscal is sweet spot. Tax collections have been very good. GST collections have been roaring. If the companies are not doing well, if the consumers are not buying anything, why would GST collections will go up? Therefore, there is a implicit the impact that we should see on the momentum of the earnings coming back as we move forward. And India is the only country where the interest rates are being cut. So the interest rate is already cut by about 20 basis points. Today, 1 year and 10 year yields, if you look at it, is about 6.2 for 10 year bond yields. So which essentially mean for companies for borrowing in the country is very at cheaper rates, very high. I did meet one of the very small SME companies, which is called less than 50 crores turnover. I just casually asked him, what is your cost of borrowing? And he said, my cost of borrowing is 8.5%. A company, 8.5%.
That's it.
8.5%. A company which is about 50 crores turnover.
Yeah, 8.5 is
and
very
8.5% is getting money from the bank, which essentially means his profit could be higher, and his burden which otherwise he used to have earlier by way of high interest rate regime, paying high interest rate for his running the business, that's now has come down. Therefore, his margin will be higher. He'll be able to create more employment. From 50 crores, he can actually aim to become 100 crores kind of things. That is an aspirational change that has come at the mid-sized companies, and also the cost of borrowing. I think the bigger plus point for India is actually the cost of capital in India has come down so much, and companies will be able to deliver better numbers as we move forward.
So Bala, just to wrap it up, if rates go down, that means somebody will take a haircut. Either an NBFC will take a haircut, or a bank will take a haircut, or the unorganized lender will take a haircut. So while interest rates going down is great news for corporate, it's great news for consumers, who will take the haircut?
So there is no haircut. I think it's about how much money you make. So like first you mentioned about the banking industry, they are all driven by the NIMs. So as interest rate come down, the cost of deposit comes down. The lending rate remains with keeping in mind the band in which you must lend. So after adjusting for your cost, so you keep a NIM of say 3 to 5% or 6%, 7%, which is segment into which you lend. So therefore, ultimately these businesses are driven by the NIMs. And other good thing on this sector is absolute profit that they make over a period of time. I think they'll keep rising. So balance sheet size is increasing, your top line is increasing, therefore your bottom line is increasing. So not necessarily the interest rate is coming down, only the period. I think there is a period where interest rate could happen. So you are not able to pass on the drop in interest rates even on the deposit holders. It takes some time. So there is a transition time of about 3 to 6 months, you can say, and transmission of interest rate both on the lending side as well as on the deposit side. But otherwise, these sectors will remain one of the big sectors, given the fact that they are proxy to the economy and they are the one creating businesses. Therefore, they will remain the sectors to watch out for even going forward.
Fantastic. Always a pleasure to have you on ET Now studio. Thank you for joining us. And I know it must be a lot of traffic, a lot of rain, yet you managed to make it all the way to our studio. Thank you very much.